Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer, and today we are going to be analyzing American States Water Company, ticker AWR. I've had multiple requests for this one now, so I'm going to go ahead and put it. I didn't check to see if they were in the S&P 500. They might be, but I'm going to go ahead and put it out for free on the YouTube channel anyway. Normally, if a stock is not in the S&P 500, I post it in Patreon and in the full Cyclical Investors Club service over on Seeking Alpha. Those links will be down in the description. Patreon's only $5 a month, and if you join there and you ever decide to join the full Cyclical Investors Club service, you can get a big discount. So check those links out. I'm also going to be using fast graphs really exclusively for, or nearly exclusively for this analysis. It's particularly useful because I'm going to be doing a dividend analysis, and I'm going to be doing a little bit different than I've done before. Not the actual analysis, but what I'm going to do is I'm going to compare what this looked like valuation-wise from a dividend valuation 10 years ago compared to what it looks like today, using like roughly 10-year time period. So we'll go back to, I think it was the end of 2013, and we'll analyze what it looked like from like 2004 up to 2013, and then I'll compare that to what it looks like when we analyze it from 2014 through 2023 / looking forward in 2024. So really what we're doing is we're comparing how things have changed, I guess, over the past 10 years in terms of the valuation of the stock and what people are paying for it right now compared to what they were paying for the dividend specifically back then, which I think since this is like a water utility, it's pretty stable. You can tell by looking at the earnings that they grow very steadily. So it's a great stock to kind of do this with. And if it works out, I might write a few articles in this style for investors, because I think one of the things that has happened is we really have like a recency bias in terms of valuations. Valuations have been pretty high, and you probably heard me talk about this before, but interest rates are higher now. So we should, all other things being equal, expect valuations to kind of come down. So it's worth going back and looking at what they were, not even during a super cheap time. Like if you look at the end of 2013, this stock was pretty much at an all-time high, right? And the wider market was making a new all-time high around that time as well. So it's not like we're going back and looking at what it traded at during a recession. We're looking kind of what it looked like in the middle of a cycle, like a normal cycle. So let's get into this. Oh yeah, and if you find fast graphs, if you think it's useful, if you find it interesting, I have a 25% off affiliate link down in the description here as well if you want to give fast graphs a try. It doesn't cost very much money, and you'll see it can be, especially if you're into, I don't do a lot of dividend analysis because they're kind of expensive right now, so I hardly ever find anything other than maybe Pfizer recently, but I still do track all these. I mean, I do keep an eye on them, so if they ever do get super cheap and maybe other parts of the market that I'm investing in get super expensive, then I'll go and I'll try to pick up some dividends. That happened in around the year 2000 in the very late 90s. You could buy like a utility or a tobacco company or maybe even some certain financial companies, and that had good, really high dividends actually back then, and they actually would outperform when the market came off that 2000 peak. So the market goes in cycles, things get in favor and out of favor. And I have 5 strategies basically different ways that I can analyze stocks with, and this dividend strategy is one. So if I need to pull it out, I'll pull it out in the future and use it more. But I'm going to, the way it works is, the question I ask myself is, if I'm really buying this for the dividends, I want to know how long it will take me to earn my investment back via just the dividends and the dividend growth. So it's very simple. If you buy a stock for a business or whatever for $100, how long will it take to earn $100 back in dividends if the previous trends continue? It's very simple, actually. But I don't see too many other people think of it this way. So now the good thing about this is it frames everything in a reference of time. So it's a little bit different than thinking of it. In some ways, it's really the same as like a CAGR or something, I mean, but in other ways, sometimes just thinking about things in a little bit from a slightly different perspective can really make you think about it a little bit more in your mind, especially when you're counting on dividends coming in over a long period of time, because it usually takes a long period of time nowadays to earn your money back with dividends. You really want to think, can I really forecast this business 20, 30 years into the future? And that becomes an extra layer of consideration when you're looking at like a dividend stock. If it's a business that's kind of on the decline, they might have earnings falling over the next decade or 20 years, so you don't want to be waiting that long to earn your money back. Okay, so let's get into this. We basically only need couple metrics to figure this out. We need to know what the dividend yield is, and we need to know what the dividend growth rate is, and what to forecast. What's a good forecast for the dividend growth? So the dividend yield is pretty easy. You can just look at most of these graphs, and if they're kind of correct, I actually think mine's going to be a little bit higher. Well, first of all, let's shorten this. We'll see. I don't think it will change. Yeah. So I'm not sure if that's forward looking or, let's see. Taking the most recently calculated annual ex-dividend by the most recent closing. Okay, so this is going to go quarter by quarter, it looks like. So it might have 1 quarter in, and it might. When I do this, I just I take the current last year's dividends that have actually already been paid, but then I pull forward the first year of growth is how I set it up. So I'll use this dividend, but I'll assume it grows already for the whole year. So now, in theory, it should come out to this number. But since I estimate my own dividend growth rate, it might be different than the fast graph. If you didn't pull that forward, then you just wanted to use the fast graph estimate, you could just use this number, right? Well, it wouldn't be that one because it's 2-year increments here, but it would just be like $1.78 or whatever. So we can take a peek at what I decided to use. I went with $1.66. So that's the end of 2023. Okay. Now, in terms of, so let's get this. We want to run this first one from 2014, I believe, to 2024. So we set the time frame correctly. That does factor into what these numbers will turn out at when we're looking at the growth rates. So for let's just look at the basic dividend growth rate in the fast graph, and then I'll show you how I make some small adjustments to that. So over this time period, the dividend growth rate was, I used the compounded one, 8.09%. Okay, so if we go here, I have the dividend growth at 8.09%. Now I also care what their earnings growth rate is. So I calculate this myself. If you've seen me do any of my other earnings videos, earnings valuation videos, you'll see I have a process for calculating this earnings growth. It takes into account things like shares outstanding, decreases like buybacks, and then years where earnings growth declined. But I don't know if I track this in my normal spreadsheet, so I probably just took this from fast graphs in this case, which for this company is probably fine to do. Well, I might have adjusted it just a little bit, or I might have used the end of this year. Didn't change much, so yeah. So I adjusted it tiny. Mine was a little bit more, slightly higher, like slightly more generous, with a 6.16% earnings growth rate. That could be because I pulled forward the earnings from here, which is what I do. That could be the difference between the fast graph and mine, which is almost the same anyway. So the reason the earnings growth rate's important is because over time, especially over long periods of time, this is the payout ratio right here. Let me move my head just a little bit here. Well, you still can't see it, but there we go. Okay, so this is the payout ratio. Once this gets over 50%, that means that the majority of earnings are being paid out in dividends. And I use the adjusted earnings from FastGraphs. So once that gets above 50%, I assume that over the long term, dividend growth cannot grow faster than earnings because dividends come out of earnings. So if this is over 50%, then I do not assume that dividends can keep growing this fast. I assume they can only grow as fast as the earnings are growing. That's a way to be more conservative because some of these companies can grow dividends really quickly for a while, but then over time they have to slow those down. So if you're forecasting out 20 years into the future, you need to assume that a really fast dividend growth rate cannot sustain itself unless earnings are also that fast. So that's what this just tries to control for and estimate. So I assume dividend growth rate of 6.16%, even though they did grow at 8% over the past 10 years. So slightly more conservative there. Doesn't make a ton of difference, but it does make a little difference, especially when you're taking this far into the future. Okay, so this is the growth rate that I'm using. The current yield, I have it 2.31%. That's almost the same as the FastGraphs 2.4, probably because they have that extra quarter maybe this year that I didn't have in there. So yeah, we have a 2.31% dividend yield growing at a little over 6%. So my spreadsheet takes that information, applies it to a $100 investment. Okay, so if you have a $100 investment, I don't know if I break it down in here or not. I do on my earnings spreadsheet. So I'm just gonna have to talk about it because I don't think I have it written out. If you bought the business for $100, it would pay you back $2.31, and that $2.31 would grow as about 6.1% each year. So the first year you have $2.31. I actually pull that forward, so it's probably more like two. Actually, I think we can go look at this if I go back deep enough in here. Here we go. So you start with $2.31. That first year, this is year one growth, you earn $2.46. The next year you earn $2.61. The next year and this is what your dividends grow. And you want this to see how long it would take you to collect $100. Okay, so this gets collected, this gets collected, this gets collected like that. All right, and then that's what this other row here is for. I started off on year 5 because almost no dividends earn enough in the first 5 years and the spreadsheet's already giant anyway. So after 5 years, you would have, on your $100 that you started with yourself, you would have made like $13, and then in year 6. So I want to know when this is going to get to $200, when you've earned all your $100 back. And so this flips green when that happens. So on year 21, you would have earned all your money back. So it'll take you 21 years to earn your $100 back from just the dividends. And 21 years is a long time. However, I would point out that I like to compare dividend growth stocks to a 60-40 portfolio, and it would actually take 20 years to do it with a 60-40. So it is still, I think maybe at least one of I had more than one person ask me for this analysis, but they noted that this was down maybe like 25% off its highs. Maybe that's the high. Let's see. So even though this is down, more than 30. Even though this is down more than 30% off its highs, it still is a little more expensive than a 60-40 in terms of dividends, in terms of how quickly you'll earn your money back from the dividend. So I haven't updated this in a couple months, but it's probably pretty close. You can see that the yield on the 60-40 is 2.43%, so it's slightly better. And then it's assumed to grow at 7% instead of 6%, so it grows slightly faster. And the combination of that means you earn your money back a year more quickly than you would with AWR if all these assumptions are reasonably close. Okay, so now what I want to do, now for me, everybody can put their own time frame that they want to on this. A lot of people get upset with me, or at least some people do, because for me, I want to earn my money back in like 10 years. Which is, I totally understand is quite low. if it's strictly a dividend investment. I was talking about Pfizer a while back. It was at like 12 years. I think that's maybe like okay. I wasn't really necessarily only buying Pfizer for the dividend, but I just kind of put it out there so people could see it in an article a while back. So for me, that's kind of, I totally recognize that's way lower, way more quickly than what most other investors are going to require. But we do have the relative valuation here, which I think shows that it's pretty similarly valued to like a 60-40. And what I want to show everybody is, even though this stock is down 30% off its highs, I want to go back to the end of 2013, like the beginning of 2014, and show you the exact same analysis, to show you what it was trading at then, right? So just so people understand, I don't think my valuations are like completely crazy now. And this isn't like the lowest valuation that it had. It was actually cheaper back in here, valuation wise, in 2011, maybe 2012. 2013 is, and beginning of 2014 is up here, right? So it wasn't super cheap. But what I want to do is take the data from this 10 years and apply it. We can literally go back in time and see what it was on fast graphs, which is kind of nice, because all you have to do is take this time period, and this is how I did it. I just shortened it down to, I think, here, and then I used this data to see what it would have looked like back then, to see what the valuation, how long it would have theoretically taken to earn your money back then. So when I do that and I run the exact same analysis, it only would have taken 16 years. So that to me looks like, relative to 10 years ago, it's 25%. It would need to fall maybe like 25% still, the price would, to get down to the valuation it was in 2014, like 10 years ago. So we can see that, and this isn't a company that's like changed dramatically or anything, right? If anything, they've actually, well, I have the fact that earnings growth is slowed baked into this. But one interesting thing that I did notice is, if you take my same, so back then, the payout ratio was slightly under 50%. So I actually took an average, and the dividend growth was smaller, but the earnings growth was faster. So in that case, I averaged these together, and my average estimate would have been about 9.6% dividend growth. Well, they actually did 8%. I mean, that would have produced a pretty close estimate to what they actually did. So they probably are pretty close to being on track, for that 16-year return on their investment. So maybe by 2030, a person that invested $100 in the stock back in the beginning of 2014, would have earned all their initial investment back just from the dividend. So I think there's a little bit of, I mean, it's just one data point, but it jumped out at me when I was like, well, these are very close. It's probably like a decent approach. So there's a decent chance this will be similar as well. Now, inflation will play into all this too, and we don't know what the inflation rate's going to be. So if we get more inflation, that could lift these up. But really, in real terms, you're not going to be any better off, really, because if you were going to spend this money, then everything costs more, right? So there are definitely things that are going to make it change up and down. These are always just estimates, but when you're doing the valuation, I think it makes sense. So when I look at AWR, even though it's 30% off its high, I would say it's not cheap. I would definitely say it's not cheap. I would say it's about relatively valued the same as a typical dividend investment, like a dividend growth investment, which is what the 60-40 is meant to. That's what this AWR ticker is up here. So on a relative value, it looks fairly valued, same as everything else. On an absolute value, I think it's expensive still. If you wanted to use like a fair absolute, you want to get down to like 16 probably, which is actually pretty normal. I say from 13 years to 17 years is kind of that where you might expect like a high quality dividend stock to normally be trading at in terms of time until payback from the dividend. So that would be like a real fair value point. Um, so it needs to fall like another 25% to get down to what I would consider like fair value relative to just everything. And then to get attractive, I mean, it would need to fall more. Probably, I mean, if someone waited till it took 12 years to pay back, which would be like another 25%, 25, another 25% more. They could totally, I would totally go along with that. And then for me, I want to have a margin of safety. So I really would probably want this like 50 to 60% cheaper, personally. And I don't sit around waiting for these, expecting these to hit that price. But if you follow enough of them, and you keep your eyes open, and things get kind of weak, and people decide they don't like them anymore for some reason, it happens. You get deals every now and then, and if you think about it, if you buy a stock that takes 20 years to earn your money back, in 40 years, you will have quadrupled your money, right? Because you double it the first 20, and then you quadruple it the next 20. But because of exponential compounding, if you buy a stock that can pay you back your investment in 10 years, you get a double in 10, you get a quadruple in 20, right? So you get a quadruple in the same amount of time it took the person paying the price they're paying today to get a double, in terms of getting their money back. But then it goes to however many 8x is after 30 years, okay? And then after 40 years, you have 16x compared to a 4x if you pay twice the amount for it. So because of the way compounding works, assuming you can get this money reinvested at some point, well, if you're dealing with dividends, you don't have to reinvest it. You're just collecting it, right? So if you're dealing in earnings, sometimes it's different because the price of the stock and everything goes up. You can't always get that money reinvested. But the point is, over the long term, the difference in paying twice as much isn't half as much in the future in terms of what you're making. It's like a quarter as much over 40 years, and it gets worse as time goes on. So that's why you don't have to find as many cheap stocks. And you can afford a little bit to sit. You can't wait forever, but you have to. But you can afford to sit around and wait a little while for some of the better prices, I think, to come around. I would say at least when you do get them, they do pay off big. They pay off more than people realize in their mind. Even me, when I started doing this, I didn't comprehend how amazing it was when you really buy something that's cheap, that's good. You can, well, let's put it this way. In 2020, I bought a bunch of stocks in March during the March crash. I bought like 30 stocks in just March alone, but I had a ton of cash because of the pandemic, and I kind of noticed it coming ahead of time, so I was really well prepared for that. But by the end of that year, I mean, I still only got like half of my money like totally invested in stocks, and because I was taking profits already in late 2020 on a lot of these because they had rocketed up so fast. But I was able to outperform the S&P 500 with like really an average of about 50% cash that year. And I don't know how much the S&P 500 was up, like 20%. And I didn't even believe it. Like I would not have expected to be able to do that. That when the market's up that much, to still be able to outperform while holding that much cash. And it was just because the things that I bought so cheap. I didn't think the ones I bought were cheap, but I mean, it just pays to get those cheap prices. So, because the returns are just magnitudes better than when you pay an average price. The hard part is you don't always get those opportunities. So you never know what opportunities you're going to get. But I just want people to know that the waiting becomes less hard when you know that when you do get a good deal, it's going to really, really pay off. So those are my thoughts on American States Water stock, and along with everything else that came in here. Let me know if you like this style of video. I can do this comparison with any kind of really dividend paying stock, and it can maybe add a little perspective for everybody. Okay, if you like this, hit the subscribe button, hit the like button. I'll see everybody later. Bye.